Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about the question, can property values continue to rise at the same rate that they have over the last 2 or 3 decades? Can property values keep going up? Will they keep going up? And it's a common question I get asked, and certainly a common concern, I would say, for most economists. They like to debate this question, and also, for people as well, because a lot of people that haven't yet invested in the property market ask themselves, have I missed the boat? Although that probably seems like the case in most asset classes, when we look at share markets and these sorts of things. Rarely is there a time when we look at the market and go, wow, what tremendous value, very little risk. Let's jump in. Typically what we see is markets are fully priced, so they seem very risky. Now's not a good time to invest, but everyone's really confident. The reverse, or the alternate to that, is markets are lower, but there's a lot of uncertainty, a lot of risk. So, in both situations, new first-time investors find it a bit difficult to sort of jump in. But I'd like to sort of step back and look at the sort of longer-term trend of property and ask ourselves what happened over the last 30 or 40 years, say since the early 1980s or so forth. Will it repeat itself? And the idea for this podcast/blog came to me when I saw a really interesting graphic put together that showed the real change in house prices in capital cities. And it's sort of a visualisation, so it starts at 1970 and goes through to sort of current times. And of course you can find that on the blog, on the website, but kind of interesting to look at how different capital cities have changed over that period of time, and there's certainly been a tremendous amount of growth. It's in fact it's possible that anyone that bought a property in a capital city in, say, the 80s, it's likely almost everyone has done well. It'd be hard not to do well over that period of time. Now, of course, better quality assets perform better, of course. But notwithstanding that, it wouldn't have been difficult to pick up 8 to 10% capital growth, even if you had a very average quality asset over that period of time. So what I wanted to do is have a look at what are the value or what are the value growth drivers? What has created, the property growth over the last 2 to 3 or 4 decades. Now, of course, I'm looking at a macro level. If we look at sort of median house prices in Melbourne and Sydney and Brisbane and so forth, so I'm making a very generalist assessment of the property market. But I guess as the saying goes, in a rising tide, all ships rise. So you just need to be on the water to make the gain. The big question is, will it be a rising tide over the next 3 to 4 decades as it has over the last 3 to 4 decades? Well, to answer that question, I think we need to understand what's driven the growth. Why has it been a rising tide over the last 3 or 4 decades? And I've discussed some of the points in the blog, obviously on the website, but the first one is population growth. Certainly, Australia's immigration policy, that is to take on a higher amount of skilled migrants than, say, other developed economies around the world. Our population growth has certainly contributed significantly to our economic growth, but also it creates demand for housing, and also it can create or make sure that the market doesn't go into an oversupply situation. So if we're building a lot of houses, that's okay. We've got the population growth to absorb that extra increase in supply. So population growth, I think, has probably indirectly contributed towards price growth, mainly because of increased economic activity, therefore higher incomes, investments and so forth, but also because of we need more houses to house a growing population. The next one is, the next factor I think that's really played a big role in the last few decades is increase to borrowing capacity. Australian banks, because of competition, so really in the 80s, there was very little competition. In the early 90s, we saw Aussie Home Loans begin as a mortgage manager to take on the big banks. And at that stage, the margins, home loan margins, were 3 or 4%. Today, they're about 2%, or they've steadied at around 2%. So the amount of profit the banks are making off home loans compared to the 1980s is halved. And then you've got the competition aspect. So in the 80s, 70s, you'd have to go along to your bank and almost beg for money, demonstrate that you're in a good career and you're in a good financial position. Whereas the tables were turned certainly in the 1990s, but certainly early 2000s, where banks started aggressively marketing to their customers for additional borrowings. And then they loosened up credit as well. If you compared sort of borrowing capacity in the early 2000s compared to 1980 or 1970, banks are probably lending 2 to 3 times more to individual borrowers at that point in time. So the banking industry really changed, and it created a massive flow of capital into the property market. And that's had a really big impact over the last few decades. Increase in household income. In 1970s, it would be typical for one spouse to be working and one spouse to be home with kids. Obviously, for those that have children. Whereas today, it would be very typical that both spouses would be working, albeit maybe one in a part-time capacity. But that has then increased family income. And obviously that family income goes towards, or is contributed towards, a better home, a larger home in a better area, and so forth. The next point is that people are buying their first home later in life. I mean, they're doing everything a little bit later in life compared to the 70s. So we're marrying later. We're really focusing on our career and increasing our earning capacity in the main. And probably most people don't turn their mind to buying their first home until their late 20s, early 30s, by which time they're probably in a stronger financial position than people in the early 20s that bought a home in the 70s, for example. So, and also the idea of or what first home buyers are looking for in their first property is a little bit more ambitious than what it would have been in the 70s as well. They don't necessarily want to compromise on location. They want to be close to entertainment, work, amenities, these sorts of things. So they're willing to work a little bit harder, save a bit more, and borrow more importantly, to get a better asset. All of this fuels property price growth, of course. The internet's had a big impact. I can jump online. Well, look at my blog, for example. I write over, say, 50,000 words a year. That's more than a book a year of sort of free information that I'm sharing after 20 years of experience that anyone can access and read at any time. Now, that just wasn't... I started the business in 2002. That just really wasn't... That was only starting to become available, but there certainly wasn't anywhere near close the amount of information that is available today. So educating ourselves about what's possible, how do we build wealth through property, how do we maximise our borrowing capacity, is it prudent to go out and borrow to invest, all these sorts of things are at our fingertips, literally, at the moment or today. Compared to 30 years ago, it was just impossible to get that information. You really had to hunt it out, and it wasn't available to everyone. So that sort of dissemination of information is a great thing. It's really good that people become more educated. But of course, it's going to mean that there's more investors, property investors in the market today, looking to make money out of property than there were 3 or 4 decades ago. And lastly, we can't ignore the fact that there's been improvements. So it's not just land value rising, but obviously people over the last few decades are spending more on the actual dwelling, on the construction of the dwelling on the property. So, more bedrooms, bigger living areas, theatre rooms, family rooms, these sorts of things. are all on a lot of people's shopping lists, and you only have to drive through sort of a new build area. And I think what the thing that stands out to me is the houses are so big, firstly, and they tend to take up almost all of the block. In fact, if you can, I was talking to an electrician. They said, in some new build areas, they can just walk on the roof and take a step to the next door neighbour if they need to look at something. It's that simple because, almost the houses are almost attached. I mean, they are detached, but there's not much room between two. And also the backyards are a lot smaller as well. So more, bigger, better, in terms of dwelling. That all adds to property price growth. Whereas, again, if you look at the 1970s, it's a small two. It wouldn't be uncommon to find a two-bedroom house, that was very small floor print that would sit smack bang in the middle of the block. That just doesn't happen today. So I think they're all the things that have contributed towards, the property price growth over the last 3 or 4 decades. And uniquely here, I'm not talking about just investment grade property. In fact, I'm talking about property at a very macro level, which I don't often do, but it's really important to sort of point out. If we look at median house price in Melbourne, Sydney, Brisbane, so forth, my commentary really applies to that sort of situation. Now, of course, if we start to apply our mind to thinking, will this property price growth persist? Then it's important to understand, what we've just discussed, what's contributed towards that price growth, and then ask ourselves, will that be repeated? And that'll help us form a view about what price growth might look like in the future. The first one is population growth, and I think population growth will be, over the next 3 or 4 decades, either equal to or higher than the last 3 or 4 decades. Now, of course, the negative health and economic impacts caused by COVID have been devastating. I really don't seek to obviously diminish their impact. However, from a pure economic perspective, if we look at population growth and if we start considering the demand for immigration to Australia, I can't help but think that the COVID situation will be probably one of the biggest positive impacts towards making Australia look like probably one of the best destinations to immigrate to. So if it's been a popular country over the last 3 or 4 decades, I think the popularity will skyrocket. Of course, New Zealand's done very well as well, but the thing that's working against New Zealand is job opportunities in terms of, particularly if you're working for really large corporates in management and so forth. That's what we want, is higher income earners. They're going to have a greater impact on the property market, and those individuals are probably going to be attracted to Australia for those job opportunities compared to New Zealand. So assuming the government maintains their immigration policy, that is skilled migration in the areas that are most needed to stimulate the economy, then I think our population growth won't reduce. Of course, it will reduce in the very short term because of COVID and border closures and those sorts of things. But again, when we're looking at property, we're very much taking a long-term view. So the short-term considerations really aren't that important. The second thing, in terms of borrowing capacity, if we have a look at sort of history of borrowing capacity, if you like, it was very low in the 1970s and early 80s. Then there was more competition, banking deregulation, mortgage managers like Aussie Home Loans and so forth got into the market. So really borrowing capacity increased significantly in the 1990s and 2000s. And then really probably since the GFC, so 2008, 2009, borrowing capacity has been trending lower. And as I've spoken about continually over the last few years, that there's been a very tight credit arena. Of course, I've also spoken about the government suggesting that credit laws will change in March this year. So there might be a little bit of loosening, but I don't think we're going to get anywhere near back to sort of pre-GFC levels, and nor should we, by the way. The prudential standards were way too loose. But also, I don't think we're going to see the same loosening or increase of supply of money that we saw over the last 2 or 3 decades. So I think borrowing capacity at a sort of macro level is probably not going to change very much. That is, it's not going to loosen, but it's probably not going to contract too much. But in terms of the massive increase in supply of borrowing, say if we look compared to the 1970s, 80s, compared to the 2000s, for example, we're not going to see the same change over the next 3 or 4 decades. So that's not going to repeat itself. That'll have a negative impact in terms of property price growth. That is, it won't reduce property prices, but it also won't stimulate them as much as it has over the previous decades. Income's going to constrain borrowing capacity as well. I mean, it's very unlikely, at least in the short term or foreseeable future, that rises in income are probably going to be equal to or less than inflation. So that means no real changes in income. So incomes will be flat or even falling. Once both spouses go to work in some form, that's not going to change. There's no sort of uplift or scope to uplift family income like there had been, again, if we compared to the 70s, 80s and 2000s. Childcare is a real problem. Childcare costs sometimes much higher than private school fees, and certainly everyone balks at private school fees in terms of how expensive they are, but really childcare is a major problem as well that needs to be addressed. So I think incomes, we're not going to have the same change in incomes as we have over the last 3 or 4 decades, and of course that doesn't bode well for property price growth. Congestion's going to get worse, of course, as density builds. And I think most economists and demographers would agree that Australia's underinvested in infrastructure, including roads and public transport. So that means that our capital cities and certainly around the CBD are getting more and more congested. And so travel times are increased. And therefore, if you want to reduce your travel time, you've got to live close to the city. And that's been true over the last couple of decades, but it's going to become more and more true. Of course, there is a permanent trend of working from home, I agree, but I think in the main, most people are going to adopt a hybrid model, so a few days in the office and a few days at home. But of course, more importantly, there are other things that attract us to a CBD or capital city location, including proximity to family and friends, schools, recreation and entertainment opportunities, those sorts of things. So it's not just a case of considering work from home and all of a sudden we can go and have a tree or see change. Some people, of course, can and will, but in the main, it's not really going to change. So I think the congestion will only exacerbate the difference in demand for inner ring blue chip suburbs compared to outer suburbs. So the demand is unbalanced now, so there's a lot higher demand in inner ring, and I think that'll just continue to exacerbate. So the gap between the demand for outer lying areas will just only get worse. Economic inequality will get worse, unfortunately. The gap between the rich and the poor only gets wider each year, and it's certainly an observable trend in most developed economies. But unfortunately, I think COVID's going to exacerbate it, because clearly if we look at the economics, the lockdowns have clearly impacted lower income earners, whereas most recent data shows that the top 40% of income earners have not been impacted at all. In fact, their income is higher today than it was pre-COVID. So unfortunately, because of COVID's going to really mean that the rich are going to get richer and the poor are going to get poorer. And so if this trend continues, and I think it almost certainly will, there's going to be a significant cohort of high-income earners that are willing and able to pay more for sought-after investment-grade property locations. So therefore, the value gap between blue-chip locations and outer suburbs, I think, will widen as well. So all of this suggests, I think, this analysis suggests and commentary suggests that probably won't be a rising tide over the next 3 or 4 decades, or at least it's less likely than more likely in my view. There's been some really unique factors that have really contributed to the property markets, particularly since the 1980s. so through the 80s, 90s and early 2000s, really benefited from some significant changes, which I've just obviously discussed, but lots of those won't really repeat themselves again. Of course, the only exception there is population growth. That's likely to have a widespread impact or a universal impact across the whole property market. But then I think because of the inequality, economic inequality, the impact of COVID, congestion, and these sorts of things, I think that there'll be a widening gap between, inner ring, inner city blue chip property compared to sort of outlying property for the reasons that I've obviously talked about. So what does this mean for investors? Well, essentially it means that I think asset selection is going to become the critical aspect in terms of generating above average investment returns from investing in property. As I said at the beginning of the podcast, just generally you could have bought almost any property in any capital city in the 1980s, and to date you would have done incredibly well. You would have built a pretty significant amount of capital value in that asset. And so the temptation is to say, well, all property does well. And I think that to some degree is correct historically, but I don't think it will be repeated. So I think we need to start investing in a way that that is based on the assumption that there won't be a rising tide over the next 2 or 3 decades, and acknowledging that there has been a rising tide over the last 2, 3, 4 decades. And if we adopt that assumption, then that means that we must pick the right asset, the correct asset, in the correct location and so forth. All the investment grade things that I've been talking about a lot through my podcasts. And if we adopt that assumption, that there won't be a rising tide, and if it turns out to be incorrect, well, what's the downside? You're still going to achieve a better than average return because you've invested in a better than average property, but it's a great way to reduce your risk. And if you are concerned about can property prices, mathematically keep increasing at the same rate, even just based on incomes, of course, the answer is no, mathematically they cannot. And does your investment strategy then prepare yourself and your assets for that occurrence, that there won't be a rising tide, which is what you're better off sort of asking yourself. So as always, you'll find the chart on the blog on the website. So I'd really encourage you to have a look at that, and also more information, of course, in the blog. As I keep saying, if you really enjoy the podcast, please share it, please rate it, leave a 5-star rating wherever you listen to your podcasts. It helps sort of spread the word and it makes the podcast rank a little bit higher, so at least I can get potential exposure to more listeners, which would be very appreciative from my behalf. And so until next week, bye for now.